What's going on, everybody? How's everyone doing? We'll start here in a couple minutes. Get some time for people to join. This will be a quick one today. We'll have a full, probably like hour-long or 2-hour-long backtesting / Q&A session on Monday after tape reading. So this will still be recorded, so if you gotta leave, feel free to. But just gonna go over some questions that were asked on stream yesterday throughout the week, and then I saw some people asking questions in the trading hall chat. So I'll do my best to answer those, and then we'll go over some market maker framework, as well as I guess some time-based stuff that was covered on the streams. And that's probably it for today. Now, obviously, if you have any questions, you can put them in the chat as well. But start off pretty solid week, I would say. Price action was decent from about Wednesday till Friday with the news profiles and such. Thursday and Friday was fantastic. Basically, very similar price action models. I wanted to cover the framework. Hold up, let me change some settings really quickly. All right, there we go. Hey, Flux, got a question. I'm new to future trading. I'm having a problem when I open trades on TradingView. Basically, if I right click and open the trade, I can't move stop loss or TP. Any suggestion? All right, so if you're using a demo account, you come down here. There should be, you should be able to just click on, I guess, all of these, but you should have a brackets profit and loss. You can click that. And that'll probably be the main solution. And make sure it's in ticks or money, whatever you want. If you're using a TradingView service for a evaluation or a prop firm, then you have to use limit orders. So it won't actually, like if I were to go in now, right, in place, actually it's closed. If you were to place a trade, you obviously get that stop loss and take profit thing. If you're using a combine or an evaluation, you have to place limit orders. So if you want to go long, you have to manually place a sell stop limit. You can just click on this little plus button. It should come up, yeah. So you can place a sell stop, and then your take profit needs to be individual limit orders. So it's a little bit more finicky with it when it comes to TradingView. That's why I preferably don't like trading on TradingView besides for demo. If you have the option to just open up like another NinjaTrader screen or a Trade-of-8 screen, it's a little bit easier if you want to set like bracket orders. But even on those, sometimes you have to just manually put in your stop loss and take profit. Yeah, it does take a couple seconds longer. Yeah, that also works too. Yeah, you can use the short and long tool, and then you can bind it to this. If you right click on it, or if you double click, I'm not sure really how to use it. Yeah, normally I just have on my left screen, I have Trade-of-8 or NinjaTrader open on the left, and I'm placing trades on there. Those are the screenshots you see in Trading Hall or in the Future Trades chat are from the other screen. It's kind of annoying to trade on TradingView, I think. Oh, I saw some people asking for the chart colors. I don't know if can I share the chart layout? Okay, see if this works. I'm not sure if it will, but if you want the chart colors, it is going to be, you can go back and watch this if you want, but this one, body will be just the third gray, and then borders and wicks don't matter too much. Just the same gray, then the blacks all the way around. And then the canvas is the main one I think people were asking about. It's going to be C3 repeated. So you can hit add, and then you type in that little number here, and then it should give you the option. Anyways, so getting to the main stuff. If you got any questions while I'm yapping, put them in the chat. But talking about market maker models today. So strictly just the stages of the delivery within the market maker model. So first of all, let's actually go over here. So if you have a market maker sell model, you obviously have your original consolidation up here, right? Then you have a low risk sell, first stage, second stage sometimes, smart money reversal, low risk, first stage, second stage, all the way up, right? So to start it off, you got your most times original consolidation, or it can just be a swing high or relative equal highs. You have your low risk. I'm going to focus majority on this right side curve, okay? So there's different things you can anticipate within a market maker model, because preferably every single morning session, there's going to be a market maker buy model, market maker sell model you're trading. Right, we saw that both on Thursday and Friday. It was a market maker buy model, pretty clean market maker buy model up here. And your best entries and best exits, the days you want to be trading, is when those are obvious to you. Thursdays as well as market maker buy model. So when we look at the framework for one, if you can anticipate certain things like stop runs and when you can find the optimal entries, I'm going to focus strictly on price here. There's not going to be any time elements that I'm going to mention in this lecture, but when you can get good at reading those and anticipating them, stop runs and optimal entries that you can pyramid on will be extremely helpful, because then you won't get stopped out maybe on a run that's retracing back into a level. So things you can look for. So obviously on your low risk buy, in this case, it'll be here. Now there's two entry types that you're going to be focusing on that will give you the opportunity to get in at the best moment most times. And these are the ones you're going to focus on, and you're going to avoid all of the other fair value gap entries and the different types of entries that may present themselves without these elements. So the two are going to be a breaker setup, where you have a up closing candle range in this case, and you can flip all these for the bearish examples, but you have up closing candle range and preferably a fair value gap that lines up on top of it. And you can go long right on there, stop loss either going below the breaker or below the swing low. Now, this is a scenario where you do not need to see it trade into discount of the dealing range. So a lot of times you can get a quick entry here and it runs aggressively. It doesn't actually drop into discount. Now, the other entry method you may see is when there's maybe a lack of a breaker. You maybe just get a market structure shift with no clear breaker, or just really a expansion leg. Then you will be using a discount fair value gap. So if there's a couple fair value gaps in premium, we're going to avoid those altogether. And that means if you don't get an entry, there's no entry. There's no opportunity to go long. But you're going to be targeting a fair value gap in discount in this case, and preferably also utilizing an order block that's within that displacement leg. It should line up either on top of the fair value gap or below it. Most times it's below it. And the stop in this case needs to go below the order block candle. So if you have 3 candles that create a fair value gap and an order block below it, then you have to place it below that 4th candle. If you have the order block creating the fair value gap, let me see if I can find an example here. Here, right? So we have a fair value gap and an order block. So in this case, you can put your stop below here and trust that it won't take out that stop. Now, if this order block was all the way down here, like for this example, right? Fair value gap, order block's all the way down here. So in this case, instead of placing your stop there, you have to place it there. Just a tiny, tiny detail, but this will save you a lot of times from price going further than the fair value gap completely, tapping to the order block and then leaving. Now, there's obviously methods you could learn to anticipate when this order block is likely to not be traded back to, but we won't cover that today. But going back to this, these are the two that you're going to be using, and it's going to be your highest probability trade setups when you have these, obviously layer it with higher time frame analysis and time and things like that. Now, when you focus on this, each of these layers, those two entry, actually, I'm going to keep those up. Each of those two entry points can be found within each stage of price delivery. So between here and here, you may have a breaker on this left side, so you use this entry. Now, as we get closer and closer, we normally find it drops less and less into discount. But each time you can measure your premium to discount. If there's a mitigation block over here, or a fair value gap in discount, you look for it to trade into that, trades off, trades into, same thing over here, and then trades off. Now, the two highest probability trade setup you'll find is this one in here, so your low risk buy, and then normally it's going to be your second stage of distribution. Now, I guess you could trade every single one, but the two things I'm looking for is the breaker setup and then the order block range that's created as a result of it trading into the breaker. When price then comes back into that range, most times you can find a high quality trade setup. So let me see if I can find them over here. So in this case, we have this down closing candle range tapping into the breaker, right? And we close away from it. We don't actually tap that one. Let's see if it pulls up on Thursday. Here we have down closing candle range, taps into the breaker. Eventually we close past it, and then you have this quick, just little run into the top end. These aren't perfect examples. I'm sure you can find some, but look for where price trades into the breaker, leaves another order block, trades away from it, taps back in, and that's also a high quality trade setup. Now, within the 1, 2, and 3, so the first low risk buy, first stage of accumulation, second stage of accumulation, you normally get about 1 to 2 stop runs. I would say just one stop run preferably. Now when it's a high resistance liquidity run, you'll get multiple stop runs over and over and over again. It's not fun to be in because basically every single time you get an entry point, there's going to be a stop run on it, then an entry point, then a stop run, and entry, and then stop run. And it's not nice to be in at all. So you're going to be looking for either a low risk buy stop run, and you get a low risk buy stop run. It's going to look like it trades into the gap. We may leave it a little bit, and then it comes back and runs that stop 1 to 2 times, and then starts to leave. So we may get it there. If we get it in here, most times you don't see it in the first stage or the second stage of distribution. Maybe you get a low risk buy in here, and it leaves aggressively, and then you see consolidation happening either on top of this order block that was formed, or just later on in price before the original consolidation has been met. Then you could see a stop run here, right? It takes out the stops, trades up, and you can look for a turtle soup entry here, or you can be looking for a fair value gap right after that stop run happens and pyramid in there, or even get in for the second stage of distribution. Now, the times you want to be careful pyramiding or finding late entries is when we're already in premium or when the higher time frame objective has already been met. So if all these are happening in discount of that daily range, you can feel comfortable about it. As soon as we get closer and closer to the drawn liquidity, if there's like multiple PD arrays, like a 50-minute IRL, for example, when we're trading into an IRL on the 15-minute chart, maybe there's one here, right? And maybe there's one up here, which maybe are both in premium. Oops. You don't know how far it's going to reach into those, right? So you got to be careful as the stop runs may occur. If it taps into this and it comes down and takes stops, you have to be looking for that as a potential for it to break market structure and now go back for the low. Otherwise, the way you want to be trading these kind of turtle soup runs and things like that is when it's an obvious original consolidation, or we're trading to a session liquidity pool in the form of an ERL and we came from IRL. That's going to be your highest probability setups for the ATM model when we're going from IRL to ERL. That's a very obvious drawn liquidity most times, and they're easier to spot, I think, than when we go from ERL to IRL, like a sell side run back up to premium. So if you go back into the examples from Friday, here was our market maker buy model, anticipated it. We got our low risk entry on the breaker. You can see it does not really tap into discount of this. It does. Taps into discount slightly there. Doesn't fill this gap a whole lot, but you have an IOFED, institutional order flow entry drill, where it just wicks it by a tick there and then trades off. So breaker extremely strong, trades up. Do we get a stop run in here? I wouldn't think so. There's not really a clear consolidation range or swing low. It's taken out. So what do you anticipate? Well, there's either going to be a first stage or second stage stop run. Now the second stage of distribution very rarely occurs and then has a stop run. That's why the silver bullet is such a good entry model, because it's a quick just get in and then it leaves. The low risk buy in the first stage. But in this case, you have a low, it consolidates, leaves it, gets close to that bisi liquidity pool, and then drops one last time. And on stream, we anticipate this being a turtle soup as it trades back into the order block, back into the fair value gap. And notice how it filled, refer back to the unfilled portion of this gap. Technically, it's up to here, right? But we have candle bodies printing up till here. So you want to trim it down. Turns back into there, still holds the order block range, right? We're not closing past the order block. That's what you want to be watching for. This takes priority when price is retracing. So bullish order block still holding mean threshold of it, still holding the fair value gap, still holding this fair value gap, but just a stop run. And it's meant to take traders out who are maybe profitable in this and are trailing their stop too tight. So it's good to keep the 3 PD rare rule regardless of how many times it breaks market structure or just below an order block. Every single time we create an order block, maybe tap it, you can trail your stop there, then to here. Then we haven't confirmed any of these, but you could trail to there, obviously, after the buy side is ran. But turtle soup entry there. And then this fair value gap was never utilized before the buy side ran. And then we get a time-based high put in. So this high is at 10:17. Wrong time, retraces back into the order block, and then eventually takes out the high at 10:43, and then tags the premium balance we had marked out at 10:49. So beautiful market maker buy model there with both price and time elements. And if you go back to Thursday, another market maker buy model, very similar, but in this case we had the stop run occurring on the low risk buy. Now these are probably the most difficult ones to trade when you see them, because we have maybe violating a breaker. In this case, we have the breaker over here. And price comes down and trades into this fair value gap within time, right? It's 9:52. So entry go here. Now, where's the stop loss have to be? Well, we have fair value gap here. The low, I would not place it there because why? We have an order block to the left of it. So it needs to go below this candle, right? Or even you put it really conservatively below the 9:32 candle. But stop loss below there, entry here. You have to weather some of these stop runs. Now, if we got the stop run and the low risk buy, you're not going to see the stop run normally in the first stage of accumulation. Sorry, the first stage of distribution in this case. I don't know which one it is, to be honest. Tags into the order block there and then runs all the way into the premium imbalance from the 8:30 news. Right at 10:28, so 2 minutes off of the time element there. And make sure you're going in and screenshotting these charts. If you're going to use it in Notion, I would say just use the replay mode. Go to your 15-minute chart. It's much easier, I've found, if you just use replay mode. Go back to like 12 o'clock or 11:15. And then every single time you switch time frames, the price action will stop there, so you don't have to keep dragging backwards, which I find kind of annoying. But make sure you're screenshotting all of the models from this week, whether it's the ATM model or even just a morning session. Don't just screenshot a little snippet of price. Like I used to just screenshot when I was focusing on the 950 macro, probably back in July of last year. I would just have my screenshot like this. And I mean, obviously it's better than nothing, but you don't get a lot of data in here, and you get too zoomed in on price action on the 1 minute chart, and you don't actually get a bigger picture of everything. And as soon as you zoom out, it becomes more clear. Obviously, zooming out on time frames as well helps clear up the draw on liquidity. But don't just screenshot this and then call it a day and have your executions. Maybe you have your entry in here, whatever, you have your stop loss and your execution labels all on the screen. This isn't going to do a whole lot for you to learn from this because you only have maybe 30 candles on the screen. If you're going to screenshot your AM sessions, at least have from 9:30 to 11 present. I would say as long as you're not zoomed out or not zoomed in too much, you can probably fit all of the price action between 8:30 and 11 o'clock, which is preferably what you want to screenshot every day, regardless if we have 8:30 news or not, because it's good to see what we're doing prior to that first injection of volatility, whether at 8:30 or at 9:30, and then you can see the elements of time playing out a whole lot more. You get comfortable taking entries maybe before 950 macro on an 8:30 news day. You get comfortable holding till time. You get comfortable holding for maybe more than 20 points. All those things come with journaling and journaling your losses. So if you break your rules or you don't journal your losses, and then you go later in the day, you're on the weekend, you're like, oh, I'm not going to journal that one. I'm just going to journal the days where I did exceptionally well. You're missing an opportunity to learn. And yeah, it's going to be uncomfortable because you have to sit there and basically stare your mistakes in the face, something you shouldn't have done. But that uncomfortability and just facing the problem and just journaling it, screenshotting it, and telling yourself, okay, I'm going to not do this in the future. I'm going to be better from it. Really, really accelerates your growth. And if you're not doing that, I suggest doing it because it's really a superpower, and you can develop such a clean model, and you get repeating patterns and trust and faith in these elements and price showing up every single day. I have a question, but not related to MXM models, so you're going to wait till you're done. Yeah, shoot it. So MXM does not need to start off with an original consolidation, and it's enough when there's a clear buy side. Yeah, like in here, we don't have a clear original consolidation point. It's just the 830 high, which is, I guess, a time-based high, right? That's your AM session high. So MMXMs can either target original consolidation, which normally happens when we have a fair value gap on a higher time frame. So if we're targeting ERL to IRL, and the IRL is our target, like see how this IRL is not our target, we swept out session liquidity pools. So I guarantee you, if this is a 15-minute or hourly fair value gap, below that is going to be original consolidation. Let's take a look, actually. Hourly chart. Yeah, so it's an hourly sibi. So in here, if we go back, this is where your OG consolidation is going to be. Right? Obviously, we have this range in here, but strictly this, if you go back, if I have access to the 5-minute chart on that time frame, we do. Here's your original consolidation forming right below that hourly imbalance. So original consolidation starting the MMXM is going to form when you have an IRL target. A lack of original consolidation or just a swing high, swing low target is going to happen when you're just targeting a time-based ERL. So that can be either previous day low, previous week low, maybe it's, like Monday's low. It can be session-based, so PM low, London low, Asian low. I'm giving you all the lows. You can obviously flip those for the highs. But knowing when you're going to target specific elements, I think, is very, very important. But that all comes with studying too. What's up, Plethora? How you doing? When do you know to look for setups after 8:30 or after 9:30? Because I notice most times when I trade before 9:30, I take losses. Maybe I'm doing something wrong. It's a good question. So the only times I'm really looking to trade before 9:30, or I guess at 9:30 using the 9:30 volatility. So 8:30 news is going to be your main one. I'd say if you want the highest probability, I'm just going to throw out everything that's low probability. So highest probability times you trade before 9:30 is going to be when you have 8:30 news and you want to use the 850 macro basically as the 950 macro. So super liquidity, target hit, it's reversing, you have a breaker, or if you have like an entry you can use within this macro time. Now I would just say preferably just focus on 9:30 to 10:30. Most of your setups are all going to form in there. Don't even worry about before 9:30, regardless if we have news or not. So macro time, 8:50 to 9, basically running liquidity, doing the same job as any other macro. Time you would use maybe the 9:20 to 9:40 window, so maybe trading right at 9:20, 9:25. The way I like to use it is a very specific entry. These rarely happen, but they're clean when they are, because you can basically get in and get out within like 5 minutes. It's when price has, I'll give you the bearish example, displaced on the 5-minute, 15-minute, hourly, so the higher time frames, preferably the hourly or the 50-minute chart. We have left a premium imbalance in this case, red. So premium imbalance, we're already trading up into it. We have maybe London low down here. So we have all the elements in place already. We're trading into the IRL. We're targeting the ERL. And on the 15-minute chart right at 9:15, this has to be specific, but 9:15, maybe 9 o'clock, we're trading to that premium imbalance and we're starting to leave it on the lower time frames. This is the 15-minute chart. On the lower time frame, we're going to see something like this, right? So the 1 minute, you're going to see it trade up, trades into that premium IRL, it breaks down, you may consolidate, and then it fills up your value gap. And then here is where maybe it's 925 here. This is where I would consider taking an entry and using the 930 volatility to then target the ERL, which on the 15-minute chart would just look like this, right? So this is what you'd be using the 930 volatility. Now the stop sometimes has to be either above here or above the entire gap. But the problem is when there's SMT and when there's the Judas swing right at 930, we could take the stop and then revert back. But as long as you trust price, this is the only time I will use the 930 volatility to get into a trade, is this very specific framework. Every other time, I don't like trading between 930 and 945 unless there's very specific conditions. But just to avoid all the stupid losses and the times when you're like, oh, why did I trade that? Just look between 930 and 1030 for your entries. I would say even you can narrow that down to 950 to 1030. But even the 850 macro sometimes is poor. I think Thursday was decently clean. But even then, it's like the volatility sometimes is slowed down by then, and the entries are not the best. Like this is a tiny fair value gap with the order block. And yeah, you know, it's a little bit more difficult. You still get decent runs sometimes. But anyways, hopefully that clears it up. In regards to ERL, IRL. Okay, so I'm reading this post by Ghost. So technically, every single IRL is going to be liquidity, right? We're never going to be, the algorithm is never going to offset its positions into a void, from my understanding. It's always going to be, there's going to be some sort of a counterparty interaction, right? There's got to be liquidity there for them, for the banks to offset their positions. So IRLs will always have ERL on lower time frames. So that's why time frame pairing is important. So on your 15-minute chart, if there's a 15-minute IRL, your ERL is going to be on the 1 minute. If you have, like in your example, a 4-hour premium fair value gap on the 15-minute chart, there's going to be, most times you want to see original consolidation that price is going to reach for. So all the pairings they'll give you here, I think it's, oh, now I'm forgetting. I think it's 1 week to 4-hour, 1 day to 1 hour, 4-hour to 15-minute, 1 hour to 5-minute, 15-minute to 1 minute. That's, I think, the time frame pairings. Obviously, it's not an exact, like it doesn't really matter too much, but if you want to cycle time frames and you see something like a 4-hour IRL, what you can do is you can go back to the 15-minute chart, zoom back, and look to see if there's consolidation there, resting above or below that 4-hour imbalance. So technically, you're always going to be trading from ERL to ERL. But when you're looking at something like a 15-minute chart, for ease of use, it's going to be ERL to IRL on that 15-minute chart, right? But in the lower time frame, it could be on a 1-minute chart. It's always going to be like, you know, sell stops to buy stops. That's why when the 2022 mentorship was released, he never really mentioned IRL or ERL. It was always sell side to buy side to sell side. But then occasionally it would just run into discount, fill a fair value gap, and then leave. That's why he simplified it so easily that you take partials as soon as it reaches premium or discount. You leave runners for the sell side or buy side because you don't know. But in this case, you can know based on where we're coming from and where we're headed to. So if we just filled, or if we just tagged an ERL, it's more likely it's going to reach into a fair value gap rather than reaching another pool of ERL. And if you go back and watch the 2022 model or the 2022 mentorship, you can see a lot of times when price is trading right for a sell side liquidity pool. First of all, it's a time-based liquidity pool. It'll be like the London session low, and will be coming from a fair value gap either on the daily chart or the hourly chart. And watching that 2022 mentorship back, I think is extremely important because you pick up on so many different examples and things that he was trying to show you and tell you with the benefit of now hindsight and understanding probably more than you did either the first time you watched it or if you didn't watch it at all. You have that benefit of just basically being more advanced than people who watched it knowing absolutely nothing. Because 2022 model was the first thing I watched from ICT, and the second time I watched it was extremely helpful, helping form this ATM model as well. Trap I fall into sometimes. Okay, that's true. I agree. It's important to not look at too many time frames. That was something I did very early on. I would look at the daily. I would look at the weekly on Monday, figure out what's the most likely weekly expansion. Then I would look at the daily. Then I would look at the 4 hour, then the 1 hour, then the 15 minute, then the 1 minute. And while that's great, because the best high quality, 300-point runs are going to happen when all those time frames are aligned. On a day by day basis, it's not going to be necessary. That's why for me, I don't use most times anything above the hourly when I'm finding my draws. Like I'll very occasionally use the 4 hour on the daily if we're overextended and there's no data to use on the hourly chart, right? Like if you go back to NASDAQ, like times when we have session liquidity pools daily liquidity pools down here in fair value gaps and we're sinking aggressively, yeah, you're going to use those. But very rarely do you see screenshots on the daily bias post upwards of the 1 hour. So find timeframes that work for you. I say if you're trading the AM session and that's all you're trading and you're basically looking at the chart that I look at it, like I'll put the 1 minute and you're trying to find 1 minute entries, scalping it, finding the entire AM session range, use the 15 minute and the hourly as your draws. Kind of mesh those together. So if it's a clear hourly, you're going to use the hourly basically as your daily chart. So what's your closest swing high, swing low, or fair value gap the daily or the hourly chart is going to reach into, just like you were taught in the 2022 mentorship with the daily candle. So what's the closest swing high, swing low, fair value gap the hourly chart's going to reach into? If it's not obvious, or once you've gotten that, you drop down to your 15-minute chart. 15-minute chart, it's extremely easy to spot your IRL and ERL. You're going to use the most recent dealing range prices within, find your IRLs, find your ERL, and look where price is likely to reach for. So in this case, if we're tagging ERL right at 9 o'clock, 9:30, where's the most recent dealing range? Well, you could take it from here to here. And at 12 o'clock, we reach into discount, but for value gap right there, there's your IRL. And it doesn't have to be specific. You can obviously pull your dealing range from here if you wanted to as well. But there's your IRL target, and obviously it's hit later in the day, but you have the framework there. You don't have to trade the entire thing. So figure out what timeframes work for you and just stick to those for a couple of weeks, maybe even a month. You're not going to miss tons of stuff, but don't go smaller than the 15-minute chart to find a draw on liquidity. 15-minute chart should be your lowest you're going to go to find a bias. Anything higher than that is great, especially when you want to find like larger trades. Then yeah, you can look at the weekly, look at the daily. Even if you just want to do it on Monday, or maybe just in the beginning, what's the daily chart likely to reach for? Just so you have maybe a bias, and then you can filter that as you go lower. But you don't need to mark out everything on every chart, because you're going to get what's called analysis paralysis, where there's too much data, too much stuff. And the more you can simplify it, like you don't see me marking up the breakers and everything, all this stuff on the higher time frames. The higher time frames will have, key stuff, premium, ERLs, and then maybe like a fib drawn, and that's about it. Keep it simple. There's no magic thing. How would you find your MMXM if you're only looking at the 1 hour 15 and the M1? Same way. So looking at the hourly chart, treating that as your daily, closest swing high, swing low. 15-minute chart will give you the framework for the majority of it. So if we're trading into it can even look like this, right? Like, trying to find an example. This in here. So see how we're filling a fair value gap? Maybe you're trading silver bullet, right? We're filling a fair value gap on the 15-minute chart. So if you refer back to that little post I did, 15-minute chart goes back to the 1 minute. So within this section in price here, this trade up into the IRL and then trades lower, this will be a market maker sell model on the lower time frame. And there you go. There's your 1 minute market maker sell model. You can look at this to go short if you wanted to. Obviously, premium imbalance in there. I wouldn't even take that entry. I would take this one here. You have a fair value gap in premium with the order block. And you can just be waiting for that. So that's an entire model right there. Wait for a 15-minute fair value gap to be filled. Drop down to your 1 minute. Look for your change and save delivery entry types. Target 20 points. There's your whole thing. So it's just the same analysis. Find your market maker models. Find the hourly draw, 15-minute gap, or stop run. Two things you're looking for on the 15. Either a fair value gap in premium or discount, or a session liquidity pool to be ran out. And the reaction from both of those, whether it's filling a gap on the 15 or taking stops on the 15, drop down to your 1 minute chart. And as long as we see that 1 minute change in state of delivery, the breaker or a market structure shift, then you find an entry point. But that's why preferably I've put in that 5 minute candle because you want to wait for that 5 minute to print. And most times it gives you better confirmation than just a 1 minute market structure shift, but that's not necessary. And obviously if you want to use an hourly chart, then you go down to your 5 minute. You really only need 3 time frames, and you'll find your MXMs on the lower time frame every single time. That's where you're going to be trading, right? But higher time frame draw, 15-minute PD array, 1 minute MXM. So something like a daily chart is probably your go-to. So 1 day draw, obvious, high, low, or imbalance. 1 hour chart for a PD array to trade into. This can be really anything within also a kill zone time. And then a 5 minute MXM within time as well. After CISD market structure. So that's going to be your framework for basically every single model that you'll ever make that's high probability. And obviously you can change up that time frame in there. You can, for me, it's the hourly 15 and 1, or the hourly 15, 5, 1. On Friday, there was SMT at the highs. How did you know the bias was bullish instead of bearish? Let's take a look. It was majority just time. So that's a good question. So if we go to the hourly chart, pretty obvious market maker buy model in here, right? I would say, if I remove everything, there's consolidation up here, and if there's OG consolidation on the 1 hour, what do you see up here on the daily chart? Something for you to study, but pretty obvious market maker buy model. So bias on Friday was bullish for the most part, right? So with the SMT at the highs, it's important to realize that as we drop into this imbalance here, you don't need it to reach into discount because we have the second stage of distribution in the market maker model, right? This is going to be your strongest entry. So 1 hour bias was bullish, dropped to the 15. We also have, I think we may have SMT at the lows. There you go. So SMT at the lows with Asian session low between YM and NASDAQ. But also the main part for me was just the framework. Okay, so this is a common AM session framework. I think it's the Omega setup or something from the PDF. But time-based, you have a high put in between 8:30 and 9 o'clock, and then a low put in between 9:30 and 10. So as soon as you see this drop, take sell side and starts aggressively trading back up with this fair value gap present, I'm already looking at this as a complete market maker buy model. This is what it's gonna follow. Just from a framework aspect, time aspect of it now, putting in a low here. If 9:30 had came up and swept this high, like so right at 9:30 we took out this high and started trading lower, then I would assume we're gonna go back into discount. So this IRL down here. It didn't happen though. So it's good to have a flexible bias. You should be marking out things that are allow you to trade one side or the other. It's always going to go up and down in the same session, right? You can be trading long and short. We can still have completely different biases and still make profit. So having flexibility of understanding, okay, if 930 run stops, if there's SMT here, then I'm going to look to be bearish. If there's no SMT, if this happens, then I'm going to look to be bullish. Most times it's more obvious which one's going to happen, right? Like that's going to be your highest probability days. It's pretty clear which side it's going to take. But if you're unsure, mark out what's logical, see what happens that first 15 minutes of trading, and then react. I guess not react, but react from what's given to you and predict the rest of it. Wednesday this week was the most difficult in my opinion. We were initially bullish, but ended up changing to bearish. Could you explain a bit of the thought process behind that? And what should we look for to change bias? Let's take a look. So Wednesday, I think, was that. I don't even remember this day. Oh, okay. So first off, what's the news profile? Well, we have 8:30 news on Thursday. So the day before an 8:30 news is not going to be impossible to trade, but a little bit more difficult, right? So if you look between, this is 10 o'clock. I'm going to actually put this back into replay mode. I don't know if there's SMT there. Let's go to Wednesday. There you go. So bearish SMT. Look at London high, that purple line. Bearish SMT there within the first 15 minutes. So wanted to reach up into here, and then it dropped and displaced aggressively through order blocks in here. So the way you can be looking for a change in bias is after that first 15-minute candle prints. We're not really going to be trading between 9:30 and 9:45 on a non-news day. Well, you look between. Wait, did Wednesday have news? Let me double check. No, I'm confused. Okay, no, Wednesday did not have news. I'm good. So first 15 minutes, we got SMT up here. Plus, what do we see in price? Well, on the 1 minute chart, it drops aggressively through areas in price you'd want to see hold, right? So we have a order block in here that was traded above. So that should be a confirmed order block. Trades through that. Order block in here was used as a bullish order block there. Drops through that. Fair value gap drops through that. Another fair value gap there, drops through that. Market structure shift here, here, and here. So on the 1 minute time frame, it's pretty obvious that price now is likely to reach for the sell side liquidity pool and maybe a discount for value gap, something like that. So using multi-time frame analysis, 15-minute SMT plus a 1 minute, pretty clear drop there during the macro time. And there was no entry within the macro time to go long, right? Like there was not a clear market maker buy model set up. This 955 short was probably your best entry, but staying flexible like that and just reading what's given to you is important. So looking for change in state of delivery. So are we closing through order blocks that should be held? A breaker. So high, low, higher, high displaces through that, or a market structure shift. And your highest probability market structure shifts are going to happen on intermediate term highs and lows. So when a gap is filled like this, and we put in a swing low and leave it, that becomes an intermediate term low. You can find different examples of this as well. But there actually was a post by T-Trades. Let me see if I can find it on Twitter really quick. And it covers CISD. And it's extremely, extremely important, I think, when you're reading order blocks. If you don't use order blocks, it's not a problem. But if you were to just learn one thing using order blocks, this is what you need to learn. So this is right from his Twitter. I'll send the link as well. But his post was memorize his signature. And it's very, very true. You should 100% memorize it. That is what it looks like for price to change its state of delivery. And that just means it's going from a buy program to a sell program, or a sell program to a buy program. So when you see that in price, then you need to be hunting. Is there a reason for us to trade lower or trade higher? By itself, it means absolutely nothing, right? Fair value gap by itself means absolutely nothing. Stop runs mean nothing by itself. It all has to be placed in context of higher time frame and lower time frame. So when you see that signature, if it's dropping below this, and we have SMT, and we just ran out an ERL, and we have a IRL below us, plus we have original consolidation over here, plus now we have macro time where it's trading back up into premium with the breaker. All that stuff basically stacks the probabilities that, okay, now this is a reason for us to not flip bearish. It also just comes with experience, I think. I would say just have two biases. If it's more obvious that one's going to play out over the other, then just stick to that one. But if you're unsure, keep both in mind, and then whatever is given to you the first 15 minutes should help clarify it. Hey Flux, I wanted to ask you, how can I journal my trades like you do in Notion? It's a good question. There is I believe a PDF, not a PDF, a video and notes and PDFs. Let me see if this is the right one. Okay, so this, how do I link? Copy message link, there we go. So this is how to set it up in Notion, if you're wondering. That's not an incorrect link. If you click on it, it'll give you the video. But that'll show you how to set up your OBS. So if you want to record yourself tape reading or record yourself trading, OBS is a free version. It's pretty solid. And then the second part of that video is how to set up Notion. So how to set up like your calendar and things like that. If you want actually how to journal trades, I have a separate video for that. I think it's posted in models and reviews. Yes. So here's the second link. And this is like the top-down analysis I go through for journaling trades. Actually, we can do one right now. We'll do one right now, and then if there's any more questions, we'll answer those, and then we'll wrap it up. So we'll do Fridays for now. And you can see what it looks like, then copy it if you want. So I like to just use replay mode. It's the easiest. So I'm going to go back to about 12 every single time. Is an SMT always needed for SMR of an MXM? I would say so, yeah. SMTs confirm the SMRs. On lower time frames, it's going to be a little bit more difficult to see, but it also, SMT also needs to be a time-based thing. So if you're just pulling SMT randomly, it's not going to work for you. So look at time. So if you're trading Forex, look at whatever the kill zone start is, maybe 7 o'clock. If you're late trading London, then 3 p.m., all that stuff. Rookie, I posted it, or it's actually in this video. When you watch the recording back, it's in the beginning, but I can go over it quickly. Just this blue, this gray, black, and then the canvas color is C3, C3, C3. I'll link the little thing up here. I'll probably just post a video on YouTube covering everything because all these settings, people were asking questions about it. Anyways, so how to journal trades. Let's go to, so I have my Notion pulled up. I don't know if you can see, I don't want to share my entire screen, but maybe I can. All right, so this is what, you may have to stop the stream and then rejoin it, but here is the Notion. Let me switch it on the OBS as well really quickly. So this is what it looks like. Hopefully everyone can see it. Give me a thumbs up. Good. Okay, sweet. So I stored in this. I put the video link above if you want to figure out how to set this up. But it's just a basic calendar. You open a new page, do /calendar, new data set, and then it's all here. But Friday, I'm putting the news profile up here. So we got E30 News. We also had 10 a.m. news, I believe. So Friday, We'll worry about this later. News, we had 8:30 and 10 o'clock. Type, all that stuff we can figure out later. But we'll go back to, gotta stop streaming. Back to the trading view. And I'll just be posting those screenshots into the Notion. I'll show you at the end so I don't have to keep flipping back and forth. But we'll go to hourly chart. And if when you're using replay mode, it should just skip to whatever time you have. So I just stop it at 12 because I don't really care about the rest of the day. But I clear out everything. And you use basically the benefit of hindsight in this case. So if you watched it live and then you go back and tape read and basically screenshot it, it reinforces that memory. So in this case, we have a dealing range, fair value gap in here. Obviously, we never really dropped into discount at 9 o'clock, which is the only problem I think we had. But since we were in this far into the market maker buy model, wasn't needed. But in this case, we're going from ERL sell side to now buy side. So we'll mark out this daily chart, or the hourly chart rather. Marking out this fair value gap. This is not in replay mode, is it? I'm gonna mark out this. We got this larger fair value gap here. I'm gonna annotate this. I'm gonna mark this out. I'm also gonna take off. Actually, we're good. So this is what it looks like on the hourly chart. Nothing crazy. I'm just keeping it simple on this. Able to find the draw. Now, what I like to do is mark out the time. So keep this 8 o'clock line here, so that I know when to start looking on the screenshot later. So this is exactly when 8:30 starts or when the 8:30 candle prints. So screenshot this. I'll add it over to the Notion. Then we'll go to 15-minute chart. What are we seeing here? Well, we've got the obvious IRL. Gonna remove that. Remove all these time-based stuff too. So from this low, still didn't drop into discount. We'll find an example where it does. It's there. So here we have fair value gap. We'll keep that, I guess that low intact. But anyways, sell side wasn't any major sell side. This is actually a poor example to show, but just so we understand how to mark it up. So 8:30 I'm marking out, 11 o'clock I'm marking out on the 15-minute chart, so you can see the entire AM session range. Anything else I see important? Normally I mark out the IRLs and the ERLs. In this case, there's not really an obvious one, but premium discount, get the dealing range in there, and then the target that was used later on. So we'll have an IRL up here in premium. And obviously if we're bullish, the IRLs are always going to be in premium. And if we're bearish, the IRLs are always going to be in discount. So there's don't have to write premium IRL, don't have to write discount IRL. You can kind of just use context clues and figure that one out. But this is all I'm going to mark out on the 15-minute chart. Probably mark out 9:30 as well. And I'm screenshotting this, posting it into the Notion. On the 5-minute, this is where it starts to get a little bit more important. So marking out 8:30, 9:30, 10. Sometimes I put in 10:30 as well. But since the draw liquidity wasn't met by 10:30, I'm not going to mark it out on this chart. On the 1 minute, we'll have everything. So buy side up here, obvious session liquidity pool. If you go into this, I'm going to check all of those. Yeah. So session high, right? Now this is where you start looking at, okay, where is a CISD breaker, and where can we now find entry points that give us a validation of the ATM model. So I'm normally marking out, is there SMT here? So is there SMT between the lows? Not really on ES and then Q. YM. There is some bullish SMT between the Asian session low, right? So we have bullish SMT there between NASDAQ. Look at the Asian session low over here, and then look at it over there. So that is your SMT. So you got SMT down here. We also have a change in state of delivery. So this last down closing candle prints above it, taps back into that down closing candle. This is a CISD point. Now we're looking for 945. Right? We're looking for that sweep of liquidity, trade into a fair value gap, one of those, then a 5-minute candle to print bullish. So in this case, we do have this breaker in here too. You can mark that out. I'm not going to. We have this candle here. We're looking either the 945 or the 950 candle to print up, right? So this 945 candle now validates an entry point where we can look for setup. So I'm labeling this with a little exclamation point, and this is from this point on, we'll find our entries. So SMT marked out. I have the premium balance up in here as well. And then make sure to get all of this, marking any fair value gaps we see on the way. And that's looks pretty solid to me. Screenshot this, send it over. I don't use standard deviation. I do use standard deviation, but very rarely. It's not like a main part of my system. But yeah, there are some people who are crazy with it, and I do admire those guys. Then the 1 minute, this is where we start getting down to the good business. So marking out all of this, we're going to now mark out basically the rest of everything. So we have a breaker in here. We've got, so this exclamation point now shows us where can we find an entry, and you can see right after it, your value gap right here, treated into. And this would be a optimal entry point. Obviously, with 8:30 news, you can find entries between 9:30 and 9:45 or 9:30 and 9:50. Most other days and even regular days, you're going to be looking between the macro time to find an entry point. And you still have an entry point up here too. Obviously, any order blocks that are used on the way up. So something like this, I'm going to mark out. Something like the stop run that we had marked out. Buy side being reached. This IRL being tagged. I'm going to mark out 10:30 as well to put in the time elements. I'm going to mark out this high being taken within that time. What time was the IRL hit? Well, we have 10:49 here. Now, make sure you're marking out the times. This is extremely helpful. It kind of seems tedious, but when you look back at screenshots, knowing exactly when the times form is helpful. So stop run here, 10:06, entry given at 9:53 within the macro time. Entry here at 9:46. Entry here within the fair value gap and the breaker, so the unicorn setup long was given at 9:42. And if you want to mark out inversion levels, you can. So you got take profit up here too. Things like that. Don't see a whole lot more. Is this inversion level? Yeah, not a whole lot, right? There's no inversions stuff over here. You can see the speed, I guess, through the levels where it's efficiently traded through. Stop run given at 10:06. Take profit here, hit at 10:10, right at the macro close. And then the high put in at 10:49. So now, this real screenshot. This entire range. Now, sometimes it's actually, I'm forgetting one thing. Marking out how far this goes. So using the callout tool, finding your entry points, measuring basically how far these ranges go is important to basically see how many points you can grab on an optimal setup. All these are important. And then I'll sometimes measure something like this, so we get the entire range, 86 points. Obviously up to here too. Don't need all of this actually. Then screenshotting between 8:30 and 11 o'clock, getting all of this stuff in. And these price levels are helpful when you're zooming in and out and there's screenshots that have different ranges. So you actually understand how far it is. Because sometimes this range may be, you know, only 20 points, but 55 points sometimes here visually it looks a little bit different. Everything looks good. You can also mark out 10 a.m. if you want to, but don't need to. Screenshot that. You can also minimize some of this stuff. And then that'll be posted into the Notion. Now let me pull the Notion back up. I'll stop streaming here. Fix it on OBS as well. So hope you can see that. And now we have all the screenshots within this range. So the hourly, down to the 15, down to the 5 minute, down to the 1 minute. And it's got everything that you're looking for on each time frame, right? So we're looking for opportunity to go long. After this candle, it's still there. I'm looking for your draws, in this case on the 15 and the hourly. And if you go to any day, all that is present on every single range. So ERL marked out here, IRL marked out there. Every single candle is your down closing candle, and then your 1 minute. All these look the same. And it's important to keep them unified, because when you're cycling through, it's easy to just go one by one and find the patterns, like marking out the times. You can see the times, entry given, exit given, range, SMT, dealing range, opportunity to go short. All that stuff is present in each one. So if you go back to today, you need to fill out the rest of this stuff. So MMXM profile, we have different options here. Well, if you scroll down, which one does it look like? These are also going to be time-based. So here is kind of a random profile. 8:30 taking buy stops, 9:30 taking the other side. So take buy stops here, sell stops at 9:30, trades up, entry given around 10 o'clock. And then we have the high put in between 11 o'clock or at 11 or between 10:30 and 11 o'clock. So that is your Omega setup. These names are nothing special, just so I can categorize them. So Omega, type. Well, in this case, we kind of just went to an IRL target. So we'll say ERL to IRL. Not the cleanest one, but ERL to IRL. I'm more concerned with the targeting aspect than what we came from. But technically on YM, we did go to London session low, or sorry, Asian session low to IRL and premium. Then this sorting mechanic is helpful, because then if you want to go into the table and start sorting this stuff, I don't know why I can't see the filter. Oh, there we go. And you want to sort this to Omega, then we have a bunch of profiles in here that all basically look the same, right? Like that is from February. And that's very, very similar to what we saw on Friday. And if you want to keep going, obviously you have more examples, like a random April 18th. Same thing in here. And these are all different days, but very, very, very similar. Obviously you have time differences, you have different entries and exits and things like that. But then you start seeing, okay, 1037, there was a high put in. What's the next one? Well, in here we have, this is a poor screenshot. This was done over my vacation, but 20 points, give him at 10 o'clock. Got some other stuff here too. Here, 10:03, getting the entry. 10:30, creating the high. 8:58 macro time, giving a shorting opportunity. All that stuff is extremely, extremely important, because then when you want to, if you're bored, you sit around, you start studying this stuff, you're like, oh, I'm now seeing the stuff that repeats that ICT is telling me about. And it's so much easier. And I've got months and months of data of this. And if I go back to the actual backtesting, this is what I used to take screenshots of. Like, it would be so zoomed in sometimes where you can't even see half of the data that's useful. Like, yeah, you get an entry point and maybe some of it, but these kind of screenshots, now that I'm looking back, are kind of useless. Like I don't even have the time or the price scale in here. I just took this with a Nokia 7. I don't know what the heck these screenshots are. But then when you start making better journals, if you can start it off better, then you can develop a lot faster. Yeah, I got you. It should be posted in the The profile should be posted in the notes and PDFs. I'll send the link in here too. Be careful with the names are kind of misaligned, but you can name them yourself. I don't really care. I will not, though, share my personal Notion. So this this whole range, like this stuff, this is my own stuff, so I have personal notes in here, but that's why I encourage you to make your own. The MXM profiles as well were formed based on ICTs morning profiles, so they're nothing random. It's just he has maybe 3 to 4, and there's about, I think, 7 profiles in here that are a little bit more specific. With time and with news profiles as well. Like normally you get, if you want to look at this too, these are highest quality ones, a little bit lower quality, lowest quality, and these can happen during 10 a.m. news or low probability. So it's good to study that. I want the higher art. Let me scroll up. I missed a lot. So what can I use SMT to find when trading XAU USD? If that's gold, I'm pretty sure it's silver. Oh, nice. Yeah, Mark, you said it. It's silver. I'm not too familiar with commodity trading though. Yeah, this will all be posted on YouTube. It'll probably be unlisted, so actually I may just post it publicly. Either way, the link will be posted in the YouTube vids channel once it's rendered. Is it right to say we can only use the 1030, 1045 silver bullet as continuation if the draw on liquidity isn't met? Otherwise, should we expect a reversal? I get quite a bit of losses trying to take a trade expecting 1030 to 11 o'clock reversals. Yeah, I would say if it's an obvious draw on liquidity, like a session liquidity pool, session liquidity pool, and it hasn't been taken, then you can look for the 1030 to 11 o'clock to find an entry. Sometimes though, 1030 and 11 o'clock won't always create a reversal. It may create a short-term high. It may trade back down to discount or trade up into premium and then continue the move into lunch. So taking trades after 1030, I would say, isn't the best idea unless there's a reason to, like something like 10 a.m. news. If you have just 10 a.m. news, trading after 1030 is fine most times because you have a lot of clear price action. But on normal 8:30 news days, normal 9:30 equity open days, trading after 10:30 or even after 11 o'clock, I wouldn't like to do because very rarely do you see, if there's no high probability entry between 9:30, or obviously between 9:20 and 10:30, it's probably a low probability day, and it's best to just stay sidelined. Are you streaming Monday since there's no news? Most likely not. We'll have a full backtesting stream. I guess this kind of went longer than I expected, so we'll probably just have a quick stream on Monday, but not a tape reading session unless the price action is exceptionally good. I'll make sure to update it in Trading Hall chat, so you'll get a ping before if there's a stream. Is it wise to try and catch the top? Oh, let me stop streaming this Notion, actually. Go back to NQ. Oh, you can see now. Is it wise to try and catch the top of a market maker sell model at the SMT? I'm studying it, but I get stopped out a lot. I wouldn't say so. It's really hard to catch turtle soup reversals like that unless you're trading in a fair value gap on a higher time frame. So the only time I would be looking to trade a turtle soup entry is if we're within a fair value gap on the higher time frame, or it's time based, so right at 9:30, and there's a reason for us to run stops in the reverse. But it's extremely, extremely difficult. Like turtle soup is the hardest entry point you'll ever get because you're literally trading the highest highs and the lowest lows. So best to, I think, stay away from that. There's very few people that I know that have a turtle soup model. Like I think I know 2 people that I've seen that are crazy good with it. Yeah. Second stage distribution, less risky. Even anything after that, like low risk buy, first stage, second stage, all that stuff. I would say if it's best to skip the first stage of distribution or the first stage of accumulation, because a lot of times we do get that stop run. But if you are aware of that, you want to enter in, maybe place a wider stop, wait for that stop run, maybe enter in on the stop run as well, then you have a better chance of just trading a single first stage of accumulation. But if I had to say one thing to study, it would be market maker models and their mechanics. So Dexter's Lab, APHIS, all those guys have solid explanations on market maker models. They use a lot of standard deviation stuff, which is perfectly fine. I just don't pull it a lot of times between when I'm actually trading. But you can see here, reversal / retracement profile given within the range. And there's also lines up with the higher time frame PD array. But anyways, trading full time now, if not, what's stopping you? I just finished up my junior year in college. So, Lord willing, I'm making this full time sometime the next year. It's all up to God, though. But if not, then I'll finish out college and then after that, figure it out. But I really enjoy this stuff. And hopefully that's what happens. But not going to force anything now. I appreciate it, man. Thank you. Hey, you guys are the best. Showing up for Saturday backtesting streams and 9:30 in the morning, asking questions, making me better. All that stuff has really improved my own trading. So I'm more than grateful for you guys. What's so special about the first 15-minute candle at 9:30? A lot of times it's just a Judas swing. So you could use the 9:30, right? But between 9:30 and 9:45, if you go back and look at old data, sometimes there's very occasionally 2 Judas swings within that first 15 minutes. So letting the first 15 minutes just print and getting a read off that is most times better than maybe entering before that 9:45 time, just for keeping you safe. That's just a rule I have to keep myself safe, because I've entered before that and sometimes it's played out, sometimes it's just stopped me out. And I've realized there's no point in trying to capture those moves if I'm going to get stopped out when I can just wait 5 more minutes or 10 more minutes and get a 90 point, 117 point run later. So that's just, it's nothing special. It's just something to watch out for and keep you safe, because the rules are there to keep you safe, not to strangle you from taking positions. And if you look at it like it's inhibiting you from getting in, then you look at your rules wrong. The rules are a safety net. So when you want to do something that's stupid, or when you want to take a trade that you shouldn't, your rules are there to say, no, just wait or don't touch it. Yeah, and it sets a general bias to look for the true drawn liquidity, URL or IRL. Because if that first 15-minute candle prints and takes out London high, and then on the 1 minute time frame you drop and you see a CISD, then we're going to be looking for a discount IRL and something that's more obvious. I have used both Apex and Top Step. I started to move away from both. I started to move away from Apex just because their payout system is a little weird. At least it was back then. I don't know if they've changed it. Top Step is great though. I've currently moved to I'm forgetting the name now. Better Resources, Trade Day. They've got some solid rules. It's a little bit more expensive with their evals, but they have no withdrawal restrictions and pretty quick 5% profit targets. You got to be consistent, but if you want to move to more, I think, easy with their rules and their withdrawals, that's the one you can. And they also allow for Ninja Trader, Trading View, all that stuff. Trying to catch these, but it's hard. Yeah, those are difficult. I mean, but even if you look right at 8:30, that time it trades into that gap after you've formed a market structure shift. So even that entry, you may have a little bit of a higher stop, but it's such a good entry that don't spend too much time on trying to get those turtle soups, I would say. Just form one model and stick to it, whether that's the order block model or anything else. Just stick to it for at least a month, and make sure you are journaling every single day, regardless if you take a win or loss or don't trade. Journal it every day of the month, and you'll get way better. It does matter on trade probability. So if it's low probability, I normally cut it in half, or even go lower. And no, I would say I just cut it in half. It's either half size or no trade. So full, half, no trade. What I like to do for drawdown, now trailing drawdown is intraday trailing drawdown is a mess. Most times it's pretty annoying, but as long as you're not trading a whole lot, it doesn't matter. And trailing drawdown actually does help manage risk in the beginning, but once you start making profits and you have unrealized profits that then move the trailing drawdown up, it's just a hassle. So if you can move away from prop firms that use trailing drawdown, it'll be helpful in the long run. But what I like to do is you take your drawdown and you split it up into 10, split it up into 8, maybe 15, 20, maybe 5, however days in a row that you would have to lose to hit your drawdown. So say you have I don't know, like a model that you only trade once a week, maybe twice a week, and you know, okay, I have a really solid model. It shows up once or twice a week, and I have an 80% strike rate. What you could do is then you could take your drawdown, split it up into maybe, I would say 5 to 10. So if you have something like 5,000 in drawdown, split that up into 10, you have 500, right? So now that's your max loss per day that you're willing to take for the trade. So if you want to maybe just trade one trade per day, then you could risk 500 on that trade setup. If it takes a loss, you're done for the day. Provides a win. Hopefully you're taking maybe at least a 1-to-1, preferably a 2-to-1. So that way you would have to lose 10 times in a row for you to blow your account, as long as you're sticking to that daily max loss that you've placed as a rule. That's what I've used for the majority of it. I don't understand how people will risk 1% of the, like if you have a 100K account, and they take the risk from the 100K, like they'll risk $1,000 on one. That to me doesn't seem super smart. Obviously, if they have a super high strike rate, like a 90% or something, you could get away with it. But then if you think about it like that, you may only have 3 losses until you blow your account, which just not even the fact that it's 3 losses and maybe you're super confident in it. It's just the fact that that now adds a mental tax in the back of your mind of, if I take this loss, I only have 2 more losses until I blow my account. And that ruins your trading sometimes, is when you have these overarching like mental barriers that you place on yourself. So if you give yourself some leeway of, oh, I have to take 20 trades or 10 trades of individual, like I have 10 days where if I lose every single day, max loss, then I blow my trailing drawdown. There's so much less mental like stress that's formed on that. And a lot of times you can perform a lot better when there's less stress, and you know, okay, if I'm only risking 10% of my drawdown in this case, which may only be 0.05 or 0.25 of your actual account, then you can perform. And obviously when you start backtesting, you can find, okay, it's likely to reach 86 points, and you maybe only need 50 points in a week. You start doing the math, you can start crushing it. You can even pass it sometimes with one trade setup, right? Like if you were to get in here, how far does this stop? 23 points. So you could get away with, if you had a 500 max risk, with one mini contract there, right? Maybe even like 12 micros, and then take profit up to here. That is literally half of your eval in one trade, right? 86 points. What is that? 86.25. 86.25 times, all in demo, obviously, 20, 17, 25. So a decent chunk, maybe that's like a third or half of an entire eval in just one high quality trade setup. And that's why I don't think majority of people should be trading every single day. Like it's very rare where you have an everyday model, unless it's on an extreme low time frame, like sub 1 minute, or maybe even on the 1 minute scalping 20 points. But these higher RR trades and the higher, at least 40, 50 points per trade are going to happen on specific days where it's obvious. 8:30 news day, obvious ERL to IRL runs on any day, and just when everything is lining up and it's just super smooth, low resistance liquidity run, like Friday. Even Thursday, I think was solid. Even reaching up into that IRL and premium was a good, like 80 points maybe? I don't know, this fair value gap up here from the entry point here up to like 95 points. It's pretty solid, right? And it's hit at 1028. Obviously it's going to be personal preference every single time. So figure out what works best for you. But I don't think it should be at least maybe like 5 trades. So whatever, split your DD into maybe, like if I were to do it, at least 5. So you have 5 losing days in a row to blow the eval. Even that is like, that's kind of tight. 10 is a solid number, I think. 10 and obviously above that, like 20, 30, a full month of losing. If you have a model that is somewhat profitable, that's kind of hard to hit. And then obviously when you take a loss, or if you're getting closer in drawdown, you split that risk into half once you've reaccumulated the loss. ICT made a video on risk management. It's called Money Management That Works or something like that. Maybe it's risk management. That's a really good video to watch. It's somewhere in the core content. Yeah, high probability order blocks. So 2 things I'm looking for. Besides breakers, so breakers will always be high probability. Either they are creating a fair value gap. So we have a fair value gap that's placed like this. We have a fair value gap here with an order block next to it. So that's creating, in some sense, the fair value gap, right? So it's next to it. Or we are filling a fair value gap. So here we have a down closing candle range. It leaves it. So when you're looking for order blocks, most times you want to see that full candle bodies closing past that potential order block. So this is a potential order block here, potential order block here, right? Hasn't closed all the way through. Now it's a full order block. Okay, so it's completely closed above that high, and it's filled a fair value gap. So price is going to like to hold that pretty well. I can hear no fair value gap really that's been formed. This dip down is forming this. What do you see in here? Well, you have a gap, fills the gap, returns into an order block, leaves it. So this is now a high probability order block, and it comes down, doesn't take out the low, trades off. Here you have a order block that fills a gap, trades up, taps into it, high probability. Here is a order block that forms the gap. So we have it doesn't really form it, but you see how there's a fair value gap right next to it here. Order block there. So breakers, order blocks that form or are in close proximity to a recent fair value gap that was formed, or it was filling a fair value gap or an inversion fair value gap. So when you look at prices like, let's go to Thursday again, things like, see if I can find one. I don't know if I will. Doesn't look like I will. Anyways, I'll link you a video that's posted a while back. It's how to read inversion fair value gaps. There's 3 videos, and these 3 are helpful. If you go to the content, it's in playlist, ICT concepts. Here we go. Okay, so this video is an advanced guide, so you should watch that last. But this video here will help with order blocks, even though it says inversion fair value gaps. This one here will help. If you want to see an actual full fair value gap one, there's one that was posted within that playlist. And then this here is for inversion order blocks, which will be used later on. I don't really use that inversion order block a whole lot, but it's helpful when you're looking for mitigation blocks and things like that. It just needs to tap the gap, doesn't need to fill it. Yeah, it doesn't need to fill it completely. Obviously, the highest probability ones are ones that fill it completely, like this, right? Like it comes up and taps this completely, also fills that other fair value gap. Core content, let me type this up. Core content month 4 is also extremely helpful. It'll go over propulsion blocks, all the different classifications of order blocks. So go back and watch month 4 of the core content, and propulsion blocks are extremely, extremely useful. Mitigation blocks, also helpful, breaker blocks, all that stuff. And if you, once you learn those, you go into the PDF, or not the PDF, but the PDA matrix. There's actually specific order blocks that hold and specific PD arrays that hold stronger than other ones, which you can find in this video there. And once you understand that, if there's something like a mitigation block and a fair value gap in premium, you don't need to see it reach up into XYZ, because mitigation blocks are the strongest PD arrays within a PD array matrix. Hopefully that clarifies some stuff. There's a bunch of resources you can find. But month 4 core content will definitely be the go-to. I think we'll go ahead and wrap it up there, right? Decent session, right? About an hour and 30 minutes. It will be posted later today. As soon as it's done rendering, I'll have it posted, and I will send the link into the YouTube vids chat. If you're in tier 2, I'll most likely see you on Monday, but I'll for sure see you on Tuesday, Lord willing, for a backtesting or for a tape reading stream. If I don't see you, then I'll catch you guys most likely on Saturday, next Saturday, for another backtesting stream. So enjoy the weekend. Take care of yourself. Do some fun things outside if it's warm. Finally heating up, at least where I am. Getting close to summertime. And don't spend too much time with the charts. So I'll talk to you guys next time. Stay safe and peace.